Welcome to the deep dive. Today, we're really getting into the weeds on Ajanta Pharma. We'll be looking at their latest consolidated results, Q2, and the first half of FY 2026 and their strategy going forward. Our mission really is to sift through the earnings call, the financial docs, all of it. We want to figure out what's really driving their growth, where they're investing strategically, and maybe most interestingly, how they're tweaking their finances for better efficiency. So by the end of this, you should have a much clearer picture than just, the big numbers.
Absolutely. And those big numbers, I mean, they look really strong on the surface, solid performance. But like you said, for someone really wanting to understand the company, you've got to look a bit deeper, right? Especially at things like how they're handling foreign exchange and this interesting shift in their working capital approach. That's where the real story is, I think.
Okay, great point. So let's start with that foundation, the overall financial health. First half of FY 2026 looked pretty robust. Revenue from operations up 14%, both for Q2 and the half year.
That's right. H1 revenue hit Rs, 2,656 crore. That's up from about Rs, 2,332 crore last year. So yeah, solid 14% growth there.
And the profit followed suit.
It did. It actually accelerated a bit in the quarter. Profit after tax, the PIT, jumped 20% in Q2. That's Rs 260 crore. For the half year, it was up 12%, landing at Rs 516 crore. So profitability is definitely keeping pace, even slightly ahead in Q2.
And beyond just the growth, you often hear about their efficiency. How are those metrics looking? Because pharma is capital intensive.
Exactly. And that's where they really shine, I think. Their return metrics are quite impressive for the sector. They're reporting a return on capital employed, ROCE, of 33%.
33, wow.
Yeah. And return on net worth, RONW, at 25%. They mention themselves these are among the best in the industry.
Nice.
Basically means they're incredibly good at turning the money they invest back into actual profit. Their capital allocation seems spot on.
Okay, so strong performance, great efficiency, usually means good news for shareholders.
You'd expect so. And yes, the board came through pretty decisively. They approved a first interim dividend of Rs 28 per share.
Okay.
Which totals around Rs 350 crore. So definitely sharing the success.
And the timeline for that.
Record date was set for November 10th, 2025, which was a Monday, and payment should be happening on or after November 20th.
Got it. Okay, now let's tackle that first puzzle you mentioned of margins. The reported EBITDA margins were, 24% for Q2 and 26% for H1, which sound okay, but maybe a little lower than you'd expect with everything else firing so well. So what's going on there? Why the discrepancy?
Right. This is a bit of an accounting quirk, you could say. It hides the real operational strength. Yeah. It all comes down to a mark-to-market, or MTM, foreign exchange loss.
MTM loss, that's a non-cash adjustment based on current contract values, right?
Yeah.
Not necessarily money out the door yet.
Exactly. Because the euro moved quite sharply, they had to book, on paper, an MTM Forex loss. It was R41 crore in Q2 and R66 crore for the full first half. Now, the accounting rules say this loss has to go into their operating expenses.
Ah, so it directly drags down the reported EBITDA, even if it's just an accounting entry for now.
Precisely. Makes the core operations look slightly less profitable than they actually are. But, and this is the crucial part, the company stressed they are absolutely protected.
How so?
Because they have hedges in place. And the gain from those hedges, which almost perfectly offsets the loss, Rs 40 crore in Q2, Rs 49 crore in H1, well, that gain has to be booked somewhere else.
Where does it go?
It goes into other income, lower down the P&L statement.
Okay, so the loss hits expenses up front, dragging down EBITDA. The offsetting gain comes in later under other income. Operationally, it's basically a wash, but the way it's reported makes the margin look lower initially.
You've got it exactly. It's a presentation issue due to accounting standards, not an operational one. So if you adjust for that, if you pull out that MTM loss noise...
What do the margins look like then?
Much healthier. The adjusted EBITDA margin jumps to 27% in Q2 and actually 28% for the first half.
Okay, 28%. That sounds more aligned with the growth and efficiency story.
It is. And that's why management is quite confident sticking to their full-year guidance of 27% plus or minus 1%.
Yeah.
They know the underlying business is performing at that level.
Right, that makes sense. Understanding that adjusted margin is key.
Absolutely. It sets the stage for understanding where the growth is coming from.
Okay, perfect segue. Let's dig into that 14% top-line growth. Where did it originate? They have 4 main verticals, right? India, Asia, Africa, and U.S. generics. Which one was really pulling the weight this time? This is where it gets really interesting.
No contest this half. U.S. generics was the absolute powerhouse.
Okay.
It only accounts for about 26% of the total revenue in Q2, but the growth rate was phenomenal.
How much?
48% growth in Q2.
Wow.
48%. and 42% for the first half overall. Just explosive.
Wow, 48%. Can they keep that up, or was that some kind of one-off benefit?
Well, management seems to think it's sustainable, at least for the rest of this fiscal year. They said it's not random. It's basically the payoff from previous work.
Hmm.
They're getting the full sales impact now from 5 products launched late last fiscal year.
Ah, okay. Delayed impact hitting now.
Exactly. Plus, they added 3 new launches in this first half. So the pipeline is feeding the growth. They're up to 50 commercialized ANDAs in the U.S. now.
50. Okay, so a solid base and a productive pipeline driving the U.S. What about India? That's their biggest piece, right? Branded generics?
It is, yeah. About 32% of total revenue. It's the anchor. And it performed really well, too. India saw 12% growth in Q2 and 14% for the first half.
Which is strong, but how does that compare to the overall Indian market?
That's the impressive part. They're significantly outpacing the market. According to IQVIA data, their 10% growth over the last 12 months compares to the overall Indian pharmaceutical market, the IPM growing at just 8%.
So they grew, what, about 30-something% faster?
32% faster than the market, yeah. And in terms of actual volume, the number of prescriptions, they grew 115% faster than the IPM volume. So like 2.1 times faster. They are definitely taking market share.
That's significant. Which therapy areas are driving that in India?
Still mostly cardiology. That's about 37% of their India sales. Then ophthalmology at 30% and dermatology at 23%.
Right. And didn't they mention something odd about the cardiology numbers specifically? Like the data looked low.
Yes, good catch. The IQVIA data apparently showed their cardiology segment only grew 6%.
Which seems off given the overall performance.
Exactly. The company basically flagged it and said, look, that seems like an anomaly in the third-party reporting. Their internal tracking shows their cardiology growth is actually in line with the market rate for that segment, which is around 12%.
Okay, so probably just a data reporting lag or issue, not a weakness in their core Indian franchise.
Seems that way, yeah.
All right, let's quickly touch on the other international branded generics, Asia first.
Asia was steadier, delivered 5% growth in Q2, 7% for the half year. Sales were about Rs, 310 crore in Q2. They mentioned that growth was a bit muted because some orders got pushed into the second half.
So they expect it to pick up?
Yeah, they're still guiding for low teens growth for the full year for Asia. They also launched 3 new products there in Q2, focusing on chronic therapies.
Okay. And Africa branded generics, that can be volatile sometimes.
It started slow this year, yeah. Only 4% growth in Q2 and just 1% for the first half. But that was mainly due to a really high base effects from last year.
So are they worried about Africa?
Actually, the opposite. This was quite interesting. They initially guided for mid-single-digit growth for the full year in Africa. But on the call, they actually revised that guidance upwards to double-digit growth for the full year.
Really? Why the sudden confidence boost?
They said the base effect gets much easier in Q3 and Q4. The comparison periods last year were lower, so they're confident the growth will accelerate significantly in the second half. It's a big positive signal, I think.
Interesting revision. But there's always that small institutional business in Africa, the anti-malarials, that's still separate and unpredictable.
Correct. That part is shrinking. It declined 25% in Q2, 17% in H1. It's now only 2% of total revenue, down from 3%. As you said, it depends entirely on aid agency procurement cycles.
Yeah.
Very unpredictable, so they remain cautious on that specific bit.
Okay, that covers the segments. Now looking ahead, strategy and investment. A company growing like this needs fuel. We saw employee costs jump 21% in Q2. That's quite a spike. Are they just hiring aggressively?
They are. It seems to be a very deliberate strategy. They're investing heavily in both products through R&D and simultaneously in the people needed to sell those products.
Yeah.
Especially the field force.
The medical reps, the MISRs.
Exactly. They now have over 5,680 MEBRs globally, about 3,600 in India and just over 2,000 in the emerging markets, Asia and Africa.
And they're adding more.
Yes. In India, they plan to add about 200 more MRs over the next 1.5 to 2 years. And the export markets, the field force is growing 10-12% this year and planned for another 7-8% next year. It's a significant expansion.
That's a big investment up front. It must put some pressure on near-term margins, even with the adjusted 27% level being stable. When do they actually expect to see a return on all these new hires?
This really highlights their long-term view, I think. Management explicitly stated it takes about 1.5 to 2 years.
2 years.
Yeah, 1.5 to 2 years to really get these new teams, especially those entering new therapy areas, up to optimal productivity.
So they're willing to carry that cost now, knowing the real payoff in terms of market share might be in FY 2027 or later.
Seems to be the strategy. They're front-loading the investment. Meanwhile, R&D spending is holding steady at 5% of revenue, about Rs 119 crore in H1. And the pipeline looks healthy, with 22 NDAs waiting for US FDA approval. So, product flow supports the people investment.
Okay, that makes sense. Investment today for dominance tomorrow. Let's shift gears slightly to the balance sheet and that efficiency focus again. You mentioned working capital earlier. We saw one big win. Inventory days dropped sharply, from 72 days down to 56 days. That's very lean.
Yeah, that's a significant improvement in inventory management. Really tight control there.
But then, paradoxically, trade receivables days, the time it takes to collect cash from customers, actually went up slightly, from 94 days to 101 days. Why would a company so focused on efficiency let collections slow down even a little? Seems contradictory.
This is probably the most subtle but important financial engineering piece in the results.
Okay.
That increase in receivable days isn't because they got worse at collecting money. It's the direct result of a conscious strategic decision. They stopped using factoring.
Factoring. Remind us what that is again.
Sure. Factoring is when you basically sell your outstanding invoices, your receivables, to a finance company. You get cash immediately, but at a discount. When you do that, those factored receivables disappear from your balance sheet faster. So using factoring artificially lowers your reported days sales outstanding or receivable days.
Right. So they used to do that, which made the collection days look shorter. Now they've stopped.
Exactly. By stopping factoring, they're now holding those receivables themselves for the full period until the customer pays. Naturally, the average collection period reported on the balance sheet goes up.
Okay. But why stop? What's the benefit of having a higher receivable days number reported? Usually investors don't like seeing that go up.
Pure cost savings.
Yep.
It was a calculated trade-off. They switched from factoring to using standard working capital loans from banks to manage their cash flow needs instead.
And the loans are cheaper than factoring.
Significantly cheaper, apparently. They estimate the interest cost difference give them a benefit of about 2 to 3% compared to the effective cost of factoring.
Wow. Okay, so they willingly took a cosmetic hit on a watched metric receivable days just to save 2–3% on financing costs.
That's it. It shows a really intense focus on optimizing every single cost element, even if it means explaining a slightly counterintuitive move on the balance sheet.
That's fascinating. Aggressive growth investment on one hand and saving tiny percentages on financing on the other.
And they did add that the move is basically neutral to the profit and loss statement overall, because they hold matching investments that offset the interest cost of the working capital loans. So net debt isn't really impacted.
Got it. Very clever, really. One last thing to touch on briefly there was that income tax search back in August 2025. Any update there?
Just a quick note on that. The company stated on the call that as of then, they hadn't received any formal communication from the authorities about the findings or potential impact. So consequently, no financial adjustments have been made. The official line is the impact is currently not ascertainable. So something to watch, but no news yet.
Okay, so let's try and synthesize all this. What's the big picture for Ajanta Pharma right now? It seems like a company firing on, well, most cylinders. Strong growth, especially driven by that U.S. generic surge and solid India performance. They've clarified the margin situation that adjusted 27–28% looks healthy. And the strategy seems laser-focused on gaining market share long-term, right? Hence the big investment in the sales force that won't pay off fully for maybe 2 years.
I think that's a perfect summary. High growth, solid underlying profitability once you adjust for the Forex noise, and a very clear strategic bet on future dominance. So what does this all mean for you, the listener?
I think the key takeaway is the strategic choice. They're prioritizing growth in market share right now. They seem comfortable holding margins around that healthy 27% level, rather than trying to push them higher, say, towards 30% in the short term by maybe holding back on investment. Instead, they're pouring resources into that field force expansion and the R&D pipeline. It's a long-game strategy. Yeah, that investment horizon is really striking. So here's a final thought to chew on. You have a company that is comfortable absorbing the significant cost of a multi-year global field force expansion. Yet, at the exact same time, they're willing to make fundamental changes to how they manage working capital, like ditching factoring for loans, just to capture a relatively small 2-3% interest cost advantage. You have to ask yourself, does this combination, this intense focus on both aggressive long-term expansion and really minute, almost obsessive cost optimization, signals an extraordinary level of confidence? Confidence that the next 2 years will deliver such explosive growth in volume and market share that it completely justifies taking on these upfront costs and making these intricate financial tweaks right now. That attention to detail at both the macro and micro level, it suggests they really believe in the runway ahead.